In less than 3 years, COMEX registered silver inventories collapsed from over 150 million ounces to under 30 million, while industrial demand surged past 160 million ounces annually. Not over a decade, not gradually, in a compressed window that most investors barely noticed. At the same time, the global silver market recorded a 142 million ounce deficit in 2023 alone, one of the largest structural shortfalls in modern history. And yet, prices did not explode to new all-time highs. They hovered. They hesitated. They consolidated. They said this kind of imbalance could not persist. They said modern markets are too efficient. They said supply chains adjust. But here we are. Exchange inventories draining. Industrial demand accelerating. Above-ground stockpiles tightening. And the price sitting near a psychological threshold around $30 per ounce, a level not sustainably broken since 2013. Here's the part most people miss. When physical supply contracts while paper trading volume expands, something eventually has to reconcile. Institutions understand this dynamic. They monitor vault flows, lease rates, futures spreads. The public sees a chart. What I'm about to lay out changes how this entire setup looks, because this is not about a short-term trade. This is about structural pressure building beneath the surface. Welcome to Market Deep Dive, where we decode structural shifts in global markets before they become mainstream headlines. The goal here is simple. Follow the data, connect the patterns, and understand positioning before the narrative fully forms. If this analysis resonates, consider subscribing and join a growing community that values context over noise. And let me know in the comments where you're watching from. Markets are global, and so is this conversation. In 2023, the Silver Institute reported a global supply deficit of approximately 142 million ounces. That wasn't a minor imbalance. Total annual mine production globally sits around 820 to 830 million ounces. So a 142 million ounce shortfall represents roughly 17% of annual mine supply. That gap must be filled from above ground inventories, vaults, exchanges, private holdings. At the same time, industrial demand reached record levels exceeding 55% of total silver consumption. Solar photovoltaic demand alone crossed 160 million ounces in 2023, up sharply from just a few years earlier. Electric vehicles, grid infrastructure, and electronics manufacturing continue to expand silver usage because of its unmatched conductivity properties. Now compare that to exchange inventories. COMEX registered silver, meaning metal available for delivery against futures contracts, fell below 30 million ounces at points in 2024. In 2021, that number exceeded 150 million ounces. That is an 80% decline in registered supply. Eligible inventories exist, yes, but eligible does not mean available. It simply means it meets specifications. The owner has not necessarily made it deliverable. Here's where the abnormality emerges. Futures markets trade billions of ounces of paper silver annually. Open interest on COMEX frequently represents multiple times the amount of registered physical metal. In normal conditions, this leverage functions because most contracts are settled financially. But when physical tightness increases, that ratio becomes more sensitive. This is not unprecedented. In 2010, silver inventories were tightening while global monetary policy was aggressively expansionary following the 2008 financial crisis. In late 2010 and into April 2011, silver surged from under $20 per ounce to nearly $50. The move was not linear. It accelerated. Volatility expanded dramatically. Go further back. In 1979, during a period of inflationary pressure and currency instability, silver rallied from roughly $6 to nearly $50 within a year. Different era, different structure, but similar ingredients: constrained supply, monetary stress, and a loss of confidence in currency stability. In 2020, after pandemic-driven stimulus measures injected trillions into global economies, silver rose from under $12 in March to nearly $30 by August. Again, rapid repricing when monetary conditions shifted and physical demand tightened. Now look at 2024. U.S. federal debt has surpassed $34 trillion. That is larger than the entire annual output of the U.S. economy. Real interest rates have fluctuated near zero when adjusted for inflation expectations. Historically, precious metals perform strongest when real yields compress or turn negative. This is not opinion. It is observable in decades of data. In 2011, real rates were deeply negative. Silver peaked near $50. In 1980, inflation was surging and real yields were volatile. Silver spiked. In 2020, aggressive monetary expansion pushed real yields sharply lower. Silver doubled in months. In 2024, real rates hover in a fragile balance. If inflation expectations rise even modestly while nominal yields stabilize or decline, real rates compress again. Now, consider the institutions. CME Group publishes margin requirement adjustments periodically. During periods of heightened volatility, margin requirements can increase sharply, forcing leveraged traders to post additional capital or reduce positions. In 2011, multiple margin hikes occurred within weeks during silver's rapid ascent, contributing to volatility. Large banks manage metals desks that monitor lease rates and forward curves. When forward rates invert or lease rates spike, it signals tighter physical conditions. LBMA vault data has shown fluctuations in silver holdings over the past several years, reflecting global shifts in storage and demand. At the same time, central banks have been accumulating gold at record pace since 2022. While central banks do not typically stockpile silver, the broader trend toward hard assets is relevant. Institutional allocation models often group precious metals exposure together. Pension funds and asset managers adjust commodity weightings based on macro conditions. Now here's where coordination becomes visible. As industrial demand rose sharply due to renewable energy expansion, mining supply growth remained constrained. Silver is often produced as a byproduct of copper, lead, and zinc mining. If base metal production slows due to economic contraction, silver supply can tighten even if silver prices rise. That creates a structural constraint. Supply does not instantly respond to higher prices because silver is not mined primarily for its own sake in many operations. This lag effect amplifies deficits. Meanwhile, exchange-traded products holding physical silver fluctuate based on investor flows. When retail demand spikes, ETP holdings rise. When sentiment cools, holdings decline. But industrial demand does not retreat easily. Solar panel installations, grid expansion, and manufacturing commitments are long-cycle decisions. This creates a potential dislocation. On one side, futures markets price silver based on macro sentiment, dollar strength, and interest rate expectations. On the other side, physical consumption continues steadily. Paper markets trade massive volume daily. The notional value of annual silver futures trading exceeds multiple times the size of the underlying physical market. But registered inventories remain a fraction of that volume. Here's the contrast. Billions of ounces traded on screens, tens of millions available for delivery. That ratio works until stress appears. The data shows that when open interest to registered inventory ratios stretch excessively during periods of tight supply, volatility increases. Not guaranteed, not immediate, but historically correlated. Federal Reserve balance sheet expansion from 2020 to 2022 added trillions in liquidity. Although some tightening has occurred since, structural debt levels remain elevated. Treasury issuance continues. Fiscal deficits persist above $1 trillion annually. That is a persistent injection of supply into bond markets. If bond yields rise too far, refinancing costs escalate. If yields fall, real rates compress. Both scenarios can influence precious metals differently. What matters is the trajectory of real yields and currency confidence. Now let's break down the mechanism. Imagine a warehouse system where delivery receipts are traded far more frequently than actual goods move. As long as most participants settle in cash, the system functions. But if a higher percentage demands delivery simultaneously, available stock matters. Margin requirements are the pressure valves. When volatility spikes, exchanges increase margin, which forces leveraged longs or shorts to adjust. That can temporarily suppress or accelerate price moves. In 2011, 5 margin hikes occurred within 2 weeks during silver's surge. Price volatility intensified. If structural deficits continue and inventories remain compressed, even modest increases in delivery, demand can create outsized price swings. This is not a prediction. It is a sensitivity analysis based on supply elasticity. Historically, sustained deficits in commodity markets resolve in one of 2 ways. Prices rise enough to incentivize new supply and curb demand, or demand contracts due to economic slowdown. In silver's case, industrial demand tied to energy transition policies complicates the second outcome. If renewable infrastructure spending continues, baseline demand remains elevated. If economic contraction hits industrial production broadly, demand could soften. These are the 2 primary scenarios. A conservative scenario sees silver consolidating between $25 and $35 as deficits gradually narrow through slower growth. A moderate scenario sees a breakout above prior highs near $50 if real rates compress and deficits persist. An aggressive scenario, historically rare but observable in 1980 and 2011, involves rapid repricing during a period of monetary instability. The key indicators to watch are COMEX registered inventories, real interest rates as measured by Treasury yields minus inflation expectations, and solar installation growth data. Lease rates and futures curve structure also provide early warning signals. The divide is not about intelligence, it is about attention. Institutions track structural imbalances long before headlines catch up. They evaluate positioning based on probabilities, not emotion. Retail participants often react after volatility expands. By then, margin adjustments, liquidity shifts, and narrative momentum have already moved markets significantly. Information asymmetry creates wealth asymmetry, not because of secret knowledge, because of disciplined observation. This is Market Deep Dive, where we decode what matters before it becomes consensus. If this connected dots that were previously scattered, you know what to do. The question is not whether silver will move tomorrow. The question is whether the structural pressures building beneath the surface resolve quietly or abruptly.